Now let us have a look at the conceptual differences between investing in shares and trading in derivatives. Or rather, if I may put it across like this, investing in an underlying asset or trading in its derivative. Alright. So when we talk of investment, investment signifies that you buy an asset and you hold it for a period of at least 1 year or more than that in order to reap a profit. Alright. But when we talk of trading, trading implies buying and selling, or selling and buying back the same thing in a span of less than 3 months, so as to generate profit through the difference. So got the point? In investing, you buy something and then you wait for the price to go up so that you can sell it and get out of it. But when we talk of trading, it can be both ways. You can either buy the thing and sell it when the price increases, or you can sell the thing when the price is more and buy it back when the price comes down. Now let us quickly see the differences. Investing in shares versus trading in its derivatives. Alright. When you invest in shares, the shares are real. You hold them in your demat account. They are your possession and you hold them for posterity. Nobody can force you to sell away or give away your shares. In fact, unless you don't want to part with them, you don't have to part with them. They have no expiry date. You can gift them to your children can give them to the grandchildren, and it can continue, all right, as long as the company is live and working. But when we talk of derivatives of the same shares, then derivatives are notional and they have an expiry life. The expiry life is generally 1 month, 2 months, or maximum 3 months. Sometimes when you trade in indices like the Nasdaq or the Nifty or maybe the Dow Jones, there the expiry period can be 1 week also. Alright. Then when you buy a share, you can buy one share or more than that. The minimum quantity is one. You can buy and sell one single share. But when you trade in its derivatives, then it has to be a marketable lot. You see, when we were discussing about the Tata Motors, we saw that the lot size was 1000. It has to be a sufficient tradable amount. Alright. Then, as I have told you earlier, when you buy a share or when you buy an underlying asset, you have to buy first and then only you can sell them. You cannot sell a share without first possessing it yourself. But when you trade in derivatives, it is both ways. You can first sell them when the price is high and then buy them back when the price comes down, if that is your perception. That is called a squaring off. Alright. Then when you deal in shares or when you invest in shares, there has to be a physical delivery. The buyer has to take possession of the shares and the seller have to hand over the possession. It may be in the demat form or the dematerial form, but yes, then the shares come into your demat account. There is a physical transaction. But when you trade in derivatives, you don't exchange any material thing because it is all notional. As we have discussed, the contract is all notional. It is just a promise. So when the parties exit from the contract, they just exchange the money, which is the profit and loss. The person who is in profit takes the money from the person who is in loss. So it is only a money transaction. No transaction of the actual goods or the actual shares. Alright. Then again, conceptually, when you invest in shares, you earn profit only if the price of the share increases because you have bought them and now you are waiting for the price to increase. But when you trade in its derivatives, it is both ways. It is not necessary that you earn when the price increases. If you have sold the derivative at a higher price and now you are repurchasing it at a lower price, then you earn in a falling market also. Alright? While investing in shares, you earn only in a rising market, but trading in derivatives, you earn both ways, in a rising market as well as a falling market. Then another conceptual thing is that, when you buy shares, gradually small quantity of shares, you build a portfolio of your shares. But you cannot build a portfolio of derivatives. Derivatives are for short periods. In fact, derivatives are primarily meant to protect the portfolio which you have built by purchasing the shares. We will see subsequently how derivatives are used to protect a portfolio. That's called as hedging. Then this also we have discussed that when you take possession of the shares or when you buy and sell shares, you have to make full payment on delivery. But here in trading in derivatives, there is no delivery as such. Everything is notional. There is no delivery. So you only pay margin money at the time of entering into a contract. That is like a guarantee. Alright. And again, this margin money is payable by both the parties, the buyer as well as the seller. In case of purchasing shares, only the buyer has to pay the money, the full amount. Alright. Another important thing to note is that when you invest in shares, you also get the dividend. When the company declares a dividend, the holders of the shares are entitled to receive dividend in cash, alright? And holding shares means you are holding a partnership or a stake in the company. So you also have the voting rights. These voting rights are there with you if you are holding, even if you are holding one share of a company, you have a voting right equivalent to that one share. Maybe out of 10 million you have one shares, so your voting right will be 1 out of 10 million, but the voting right is there. All right. But when you trade in derivatives, there is nothing. It is all notional. It is in the air. So you neither get dividend nor you have any voting rights. You are just entitled to receive the profit and loss of the trade depending upon whether your perception before taking the trade was right or wrong. Alright? Because on the expiry date, this derivative contract will just vanish in thin air. As it is not there, it is a notional thing. But on the expiry date, it will cease to exist as a notional thing also. So I hope you have understood the conceptual difference between investing in an underlying asset and trading in its derivative. Now, if so much is clear, then in the next lesson, we shall see a live example of trading in futures. All right.